Okay, Scale AI, they kind of flew under the radar, but they're a YC company. They are doing synthetic data creation, I guess, for training machine learning models and stuff, but they're at like billions of dollars of revenue. One of the early founders exited, sold her stake, and now runs Backend Capital. She's actually out of Miami, probably run into her at some point, but yeah, she now runs Backend Capital. I would imagine it's extremely hard to run a successful VC firm. Huge leverage, but is that true? Because I would think like the VC firms, it's like the McKinseys, the Bains, like these companies are well positioned because they have all like the market insight. But for a solo venture capitalist to start their own firm, what do you think are the odds that they would like actually succeed with that?
VC is just a money manager, right? If you imagine a hedge fund manager, right? A hedge fund manager has a job of they're going to raise money from these institutional investors or high net worth individuals. They are going to get money that they have control over for a certain period of time with the expectation of producing a certain number of results. Their job is to get the investors to trust them and to produce good results for them. That then leads to the investors trusting them more with more money and keep the whole thing circling. One of the really tricksy bits about being a private equity investor, as opposed to say being just like a hedge fund manager, is that the trades that you're going to do take a lot longer, right? So your typical venture capitalist has like, maybe 24 months to be figuring out which companies they're going to go invest in. And then they've got a 7-year time horizon to be putting the money to work in those companies to be generating the returns from those. So often what they're doing initially is making some small bets to see which companies are sort of popping up. So like out of however many people are coming in, they're trying to figure out, okay, let's make some small bets. And then a few of those really succeed. And those are the ones that they're going to put the rest of the money into, right? So get that shooting up over the course of that 7-year or whatever it is period. But their job is to get the money from the real investors, what are called the LPs or limited partners, and generate returns and generate the trust that they're going to get returns and that they're going to get returns in a way that is consistent with their values. Because, if you're talking to like a family office and the family has certain ethical considerations, I mean, this is a much bigger deal than it used to be of like, who else am I going to be investing alongside? So one of the things I would ask a VC who was interested in talking, like if this guy from New York was really interested in having more of a conversation, I want to understand like where his money's coming from, because he's not investing, he's investing those people's money. So who would I be getting in bed with? And if I start finding out that it's some authoritarian regime that's putting sovereign wealth money in, I don't really want to do business with that. I remember when I was getting like Jessica's engagement ring, like when I was getting proposed to her for marriage, it was important to me that I not get a diamond from, some really bad part of the world. I wanted to get a Canadian one.
Real quick, unlike Ethereum, there's no gas limit on expressing your gratitude, so go ahead and click that like button. Thank you.
So the VC's job is to raise the money and then to put it to work. So now you ask, like, how would they do that? How could they be successful? Well, if they have raised money before, then they probably have access to the people who they raised from, not just the proximate people, but like if when you go talk to a VC, right? And if you're trying to pitch to a VC, it's a good idea to be thinking about who those people are going to be, because regardless of whether you care who they are from a point of view, you should care about it, because the way the VC is going to put you to work is not just taking your company and trying to make returns, but also trying to build trust, right, with their LPs. So the VCs often have conferences. I don't know if you've sort of seen these. Sometimes they become a little bit more public, but often they're pretty private, just for the LPs and for their prospective LPs. Say, hey, here are our companies we're investing in. Dog and pony show, here they are. Aren't they so credible? Don't you think this was a wonderful set of investments we just made? Okay, we're doing another round now. We're doing another fund now. We want you to come be part of it. And that's sort of the nature of it. So whenever you're pitching to the VC, you're not just trying to persuade the VC, you're trying to arm the VC with information that will make them look good in front of their real customers, which are their investors.
I'm just wondering if you have any sense of like there are stats about like 9 out of 10 businesses will fail and stuff like that. Like I'm wondering how hard of a space that is. Like we see Y Combinator has been very successful, right?
Y Combinator was successful and failed a lot.
Of course, but if you just look at their return on capital, my guess is it's massive, right?
Well, they've been associated with a few, they've been super early investors in a few super unicorns, right? Or decacorns. I mean, they were like Airbnb and some of these others. So certainly they've done, I have no doubt that like, Paul Graham has enough money to live on,
Well, they've grown though. They're still doing this. And also there's some rate of return. I don't know. Maybe it's not public, but they have some rate of return as a fund, right? Or is that the benchmark that would be used to measure their efficacy, or?
It depends really on what your mission is. I think in the case of Graham, he wants Y Combinator to be kind of synonymous. He wants to be the Harvard, right, for startups. He wants it to be that, like, this is, and he's gotten that, right? You see Y Combinator, you're paying attention, and he wants that to be that kind of brand name that people associate with it, that then allows that to just be a growing and self-sustaining network of success that then also helps the startups become more successful. And I think there's a lot to that, and I think that's great. I mean, going back to this person you're talking about who's like the solo, right? That person's credibility is on the line, and they're using their personal credibility to make investments. So how well that personal credibility works is going to be the whole thing that carries the day. And similarly with Graham, initially it was his, right? And then he sort of, because he liked what Sam Altman was doing over at Looped, he brings in Sam Altman to do it, and he was doing a pretty good job. And then Michael was doing a good job, Michael Siebel, and just sort of turning this into a more self-sustaining machine that goes from like having batches of a dozen companies, which looks much more traditional incubator-ish, to having the hundreds that they do now. They want no longer to be the super elite tiny company. They don't want to be Swarthmore. They want to be Harvard, right? They want to be all the top talent. They want to go there. And of course, I say that as Yale.
As always, if you want to stay apprised of the latest around emerging tech, then go ahead and hit that subscribe button. Thanks.